it's kind of an interesting, scary day on the auto finance front. We got numbers from Credit Acceptance last night. You know, it's such a strange company. Anyway, they reported a miss. They reported $5.43. They did what we sort of thought they probably would do, which is they took another sizable write down to their book, basically their forecasted collection rates, took a step down here again in 3Q in spite of what was fairly resilient used car pricing during the period. Bottom line here for Credit Acceptance Corp is that the backdrop continues to deteriorate. They did talk about on the call sort of the competitive environment getting better for them. I think what that is sort of a euphemism for is that many other lenders are basically pulling out of the space, leaving sort of just them. So I guess it is getting better in that respect, but usually if everybody's kind of getting out of that business, that's probably not a great sign. I think the outlook here is unchanged, obviously, from our standpoint. Obviously, our expectation from a macro standpoint is that things are going to continue to deteriorate on the labor front. We wouldn't be surprised to see ongoing weakness in used car pricing as well. So not just the frequency, but also the severity side. What we would be looking for from a turn standpoint, i.e. Eventually potentially turning from bearish to bullish down the line, would be a cessation in these write downs, a little bit of a basically a stabilization, particularly in that 2022 vintage. That's going to be the sort of key river card to keep an eye on there.
I mean, what would get a cessation in write downs when you haven't even, or you are entering a recession now, but once people start actually losing their jobs, then you get the anti-secession, you get the capitulation, do you not?
That's right. Yeah, no, we would expect things to continue to get worse long before they get better. I'm just trying to sort of paint a picture, not just of our bearish view, but what would it take to sort of put us potentially on the other side here down the road?
Yeah, it's bad. It's really bad. And slowing in rate of change terms, because bad is bad, but slowing is worse. The Chinese data last night, a lot of people, including myself, yourself, of all the countries that have easing base effects, that's at the top of the major country list, right? So for them to show, they had the 1 month acceleration that Felix and I talked about, off the low, but the trend is down. PMI back below 50. So you got that. But guess what? European stocks stopped going up when, Steiner? April. That's this April. And Europe's been leading the U.S. because both currency short and equity short, because European stocks stopped going up in April, because that's when in Q2 Europe started pricing in that they'd enter a recession by the third quarter, which of course they did. This is a third straight sequential slowdown in Austria, third straight sequential slowdown in Sweden. If you didn't know that, you don't need to call your friends in Austria and Sweden.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.